Do not buy real estate in these 5 US cities. If you're planning to buy real estate property, you might want to stay away from the following cities. Number 1, Bethesda, Maryland. Consider this. In Bethesda, the median listing price is $1,219,050, while the median home value is $971,090, which equates to an overpriced value of $247,960. In Bethesda, there is roughly a $250,000 disparity between listing prices and home values. According to Zillow, the median value of a house in the United States is $243,225, and that's a full house, which is slightly higher than the disparity. So what exactly is going on here? For starters, inventory is low and there aren't enough homes to go around. Also, Bethesda magazine said that there's a growing tendency for homes in walkable communities, which means condos and townhouses are selling the quickest. However, this has pushed up the price of these smaller homes, meaning that homeowners with larger houses are no longer able to profit from their property's value by selling and downsizing. Simultaneously, homeowners who are aware of the housing shortage may be trying to hold out for a higher price, increasing listing prices to ridiculous heights. Apart from that, ownership of real estate is not absolute. Zoning and other government land use regulations will have an impact on your property ownership. Private agreements such as homeowner associations or condominium association agreements may have an impact on your ownership. Well, it's pretty clear that having a place with a promising economy and a safe community comes at a price, which explains why Bethesda, Maryland's cost of living may be rather high. Apart from the real estate costs, it is well known that Bethesda is around 60% more costly than the national average, with housing costs accounting for the majority of the difference. Number 2, Arcadia, California. The pandemic, together with all its short and long-term effects, has resulted in a rapid increase in demand for housing combined with historically low supply. This is especially true in states with high living costs, such as California. According to a survey done by the Public Policy Institute of California, or PPIC, between March 6th and March 17th of this year, 55% of Californians are concerned about not being able to make their rent or mortgage payments this year. Many inhabitants of California are considering relocating due to the growing expense of living. A record high 46% of Californians say the state's high housing costs have prompted them to seriously consider moving from where they are now or leaving the state entirely. Arcadia, for instance, like much of the San Gabriel Valley, profited from a large number of foreigners purchasing houses in the United States. Chinese buyers have been particularly interested in that area. However, a slowing Chinese economy, along with the trade war and anti-immigrant rhetoric in the United States, has curbed China's buying spree in Southern California. It also implies that many of the residences bought by Chinese nationals are now vacant. The problem has become so severe that the city of Arcadia now requires owners of vacant homes to register them so that the city can directly engage with owners and/or their designated agents when difficulties arise. Number 3, New York City. Hold up. Before we continue, go ahead and click the subscribe and the like buttons. It takes a lot to make these videos. Your small actions tell YouTube to keep promoting our videos. Also, tell us in the comment section which one of these cities you have been to. Thanks. Now back to the video. When you buy a home or a condominium in New York, the monthly mortgage payment is only a portion of the total cost of ownership. Let's say you have a $3,000 mortgage. You will have to pay taxes on top of your monthly rent, which can range from a few $100s in New York City to thousands in Westchester. If you buy a condo, you'll have to pay common charges. And if you live in a co-op, you'll have to pay maintenance costs on a regular basis, which can add up to $1,000 to your monthly mortgage payment. For example, if you purchase a home on Long Island, you'll inevitably need to fix a leaking roof, a broken furnace, frozen plumbing, and other issues in addition to your monthly mortgage and expensive taxes. All of these things will add thousands to your annual carrying costs. Considering this situation, that $3,000 monthly mortgage payment isn't paying down any principal for the first 7 to 9 years on a 30-year mortgage. Instead, the majority of those initial payments will be used to pay off the debt's interest. You're not paying off any debt or building equity in the property. All you're doing is hoping it appreciates in value. because that's the only way you'll be able to sell the house for a profit. In the event that you can't manage paying all of these fees, there are a lot of things that you need to be mindful of, including lien sale. When you don't pay your property taxes, water bills, or other charges against your home, they become tax liens, which can be sold at a tax lien auction. The Department of Finance sells tax liens every year. What happens is that they will sell your tax lien debt, the amount that's outstanding, to an authorized bidder if your property has an unpaid debt that qualifies for a lien sale. A lien servicing company adds further fees and interest to your debt on behalf of the buyer. So it's much better to pay off your debt before they sell the lien. That's a lot to handle, isn't it? Number 4, Dallas, Texas. Houston, Dallas, and Austin are all similar for an investor's perspective. They have strong economic growth and strong property demand, resulting in home prices rising by roughly 7% in the last year. The Dallas real estate market has clearly cooled, although it's unclear if this is simply a return to normal prices or anything more. According to Redfin data, Dallas home prices have dropped 39.7% since last year, yet prices are still rising, only more slowly than before. According to a D Magazine article published in July, apart from that, houses built in the last 10 years are hard to come by in Dallas. As houses age, the number of repairs increases. When many things fail totally, they must be repaired or replaced. That is why we advise buying a home that is less than 10 years old. Over time, things deteriorate, which can be expensive. After 10 years, carpeting, paint, and appliances start to wear out or break down. Pipes, roofs, and windows, among other things, are more complex and costly to replace in older homes. What is evident is that there's still a large migration of people to the area, which tends to drive up property prices. But Dallas is also building more new homes than any other city in the country. Although it may still be a wonderful spot to invest, you should proceed with caution. Number 5, New Orleans, Louisiana. In New Orleans, the median listing price is $327,650, while the median home value is $168,820, which means that a typical real estate property is overpriced by roughly $158,830. When compared to about $248K in Bethesda, a disparity between listing price and home value of roughly $159,000 may not seem like much. However, in percentage terms, it's extremely huge. According to Zillow, one of the biggest American online real estate marketplace companies, houses in New Orleans are being listed for nearly twice their real value. The NOLA housing market, on the other hand, looks to be pretty stable, with Redfin reporting a slightly average price gain over last year. One factor could be the sorts of homes that are selling. A growing number of home buyers are looking to the suburbs as an alternative to the city's exorbitant pricing, according to an article on the website NOLA.com. This comes after years of continuously climbing prices, according to one local real estate expert.